If you are a W-2 earner and you're interested in real estate, hear me clearly. You are in a powerful position because real estate is one of the most tax advantage wealth tools ever put in the tax code. And it's because real estate ownership gets extraordinary tax rewards. And as a W-2 earner, you are in an even more unique position because your W-2 is leverage. Stable income makes borrowing easier. Real estate gives you depreciation and a ton of tax planning options that can reduce your taxable income legally. See, when you combine the two, you're not just earning money, you're building a machine. And by the end of this video, you will have a real playbook for the main ways you can use real estate to offset your W-2 income and taxes today. So here's the roadmap for what we'll be covering today. Number one, the 3 income buckets and why passive activity loss rules matter. 2, we'll be going through the mom and pop rental loss allowance. 3, we'll be going through reps or real estate professional status. 4, we'll be going through STR or short-term rental loophole. Number 5, we'll be going through cost segregations, seeing how paper losses get created. And if you stick around to the end, I promise to show you an additional 6 bonus real estate related tax strategies that you can use today. And if we haven't met, my name is Kingsley Ifedi. I'm a CPA, certified public accountant, and I specialize in proactive tax planning for high-income business owners and families. See, over my career, I've advised clients across more than 40 states, representing over $300 million in combined revenue. So I've seen exactly how wealthy families and business owners actually structure things to save thousands of dollars in taxes each year. But before we hop into it, quick disclaimer, yes, I am a CPA, but I'm not your CPA unless you hire me. So this video is for educational purposes only and not tax advice. Tax planning is highly personal and your specific facts and circumstances matter. So let's hop into it. First, I want to start with the 3 income buckets. See, most people think taxes are one big pot, but in practice, there are actually 3 main buckets that income gets split into, and they're all taxed differently. See, bucket 1, that's earned income. That's your W-2 wages, right? And your business income. This is the income that you go out and you actually clock in to work for. Bucket 2 is portfolio income. Think stocks, crypto, dividends, and even interest. Bucket 3, passive income. That is rental real estate and passive investments. And here is why this all matters. See, back in the day, people used to use paper loss deals as tax shelters. They'd buy an investment, create a big paper loss, and use it to wipe out their entire W-2 income. So in 1986, Congress created Section 469 to stop people from using passive paper losses as tax shelters to wipe out their W-2 income. It's basically the gatekeeper rule that we'll be focused on today. These losses usually stay in the passive bucket until you qualify for an exception to be able to use it against your W-2 income. And that's the opportunity that we'll be talking about today. See, legal state has legal doors that let you unlock those losses when you meet the rules. And that's why we even talk about this section in the first place. See, if you did nothing today, here's the default result. Let's say one of your rentals show a $50,000 tax loss this year. In most cases, that loss does not offset your W-2 income right away. And by default, that loss stays locked up in the passive bucket and it gets suspended and carried forward. Then you can use it in a future year where you have passive income to absorb it. Or you can unlock it when you sell the property. The loss isn't wasted, it's just waiting. But waiting is expensive because that means your tax savings show up later and not now. And if you know how to unlock those losses legally, you can turn that future tax benefit into a tax benefit today. So the passive activity loss rules did not kill real estate tax benefits. It just made the game about rules and buckets. And to play the game effective, you have to understand where the loss comes from, because most real estate losses are planned by leveraging the magical word, depreciation. Depreciation is the real advantage when it comes to real estate. Depreciation is a non-cash deduction, which means you can be cash flow positive and still show a tax loss on paper. Depreciation is essentially the IRS allowing you to deduct the cost of the building over time. See, for residential properties, you can depreciate it over 27 and a half years, and for commercial, you have to depreciate it over 39 years. And later, I'll show you the exact tax strategy that investors use to accelerate that depreciation with something called a cost segregation study. And that's why real estate looks like a cheat code from the outside. And that's why almost every wealthy person invests in real estate and uses it intentionally, because they buy assets that create paper losses while that asset builds equity and appreciation over time. Now, don't miss this. Depreciation is the engine, but the rules decide whether the engine's power can actually move the car forward and get the benefit or not. So let's go through the exact strategies that turn those real estate losses into usable losses against your W-2 income. Now, it's important for me to mention, because most people never do, before a real estate loss can actually help you, it usually needs to clear 3 gates. Gate 1, do you have enough basis? Which means you can only deduct losses up to what you've actually invested in the deal. Gate 2, are you at risk for the money? Meaning you can only deduct losses to the extent you're truly on the hook financially. And gate 3, the passive loss rules under section 469. For today, we're going to mainly focus on gate 3, because that's the gate for most people that decides whether or not real estate losses can actually reduce your W-2 income. And if you've ever seen a big loss not show up on your tax return like expected, it's usually because of one of these 3 gates. So strategy 1, the mom and pop allowance. This is the first strategy you can use to offset your W-2 income with your rental losses. What is it and who does it help? See, the mom and pop rental loss is the starter play for a lot of W-2 earners. If you, keyword, actively participate in rental real estate, you could potentially use up to $25,000 of rental losses to offset your other income. And here's what actively participate really means. It's not the same thing as running everything yourself. That is called material participation. Active participation and material participation are not the same. Active participation is a much lighter standard, and it basically means you are involved in the management decisions. For example, you improve tenants, you approve repairs, you set the terms, but you do not have to do every task yourself. Material participation is a much stronger standard, and that is about being meaningfully involved in the actual operations. It's time-based and involvement-based, but hold on to that. We'll come back to it later. So to recap, with the mom and pop allowance, you can use up to $25,000 of rental losses if you actively participate, but it does start phasing out once your modified adjusted gross income goes over $100,000, and it is fully phased out once you're at $150,000. So if you're at an income that is above the $150,000 range, that will not work. It will not work, but you might be able to qualify for this next one. Here's the second tax strategy, REPS, otherwise known as real estate professional status. This is a second strategy you can use if you want to use your rental real estate losses to offset your W-2. What is REPS, or real estate professional status? Let's just keep it simple. REPS is not a license. It is a status based on time and involvement. This strategy is not capped at the $25,000 like the mom and pop limitation, meaning it can allow you to offset major rental losses against your W-2 income. Now, do keep in mind, there are 3 things that you need to qualify for real estate professional status, and you need all 3. So first, real estate has to be your main work, which means you spend more time on real estate than all of your other work combined. The second thing you need is you need to put in at least 750 hours in real estate during a year. Another thing to keep in mind here, you can't combine hours between spouses to hit this 750-hour requirement. One spouse has to hit it on their own. And the third thing you need to qualify for REPS is you need to materially participate, meaning you have to actually run the rentals, not just own them. See, in practical terms, material participation means that you're actually running the rental business and you're the one making the decisions. You're directing the work, you're overseeing the results, you approve tenants, and rental terms, you decide pricing and renewals, etc. You choose the vendors and authorize the repairs, you manage turnovers and inspections, you review the numbers and make the final calls. In other words, you're the operator, not the passive owner. Material participation has specific tests in the IRS regulations, and there are 7 tests, but you only need to meet one of them. But the simple takeaway here is this: you actually have to run, not just own them. Now here's the real opportunity not a lot of people realize. If you're married filing jointly, only one spouse needs to qualify for reps for the whole entire household to qualify for reps. That means if one spouse is a stay-at-home parent, they can be the real estate professional and the other spouse with the W-2 can keep earning. For example, let's say the husband is a W-2 dentist making $300,000 per year, and the wife is a stay-at-home mom taking care of the kids. Let's say they buy a rental property for $750 and it's a long-term rental. They run a cost segregation study and it creates a $140,000 paper loss this year. If they do nothing special, that $140,000 usually cannot be used to reduce the $300,000 of income. And that loss would just sit in the passive bucket and be carried forward until future years where you have passive income to offset it, or you sell the rental property. But if a stay-at-home mom qualifies for reps and materially participates, that $140,000 loss can potentially offset the W-2 income of the other spouse. So instead of being taxed on $300,000, they could be taxed on around $160,000. And in my case, I have seen many of my clients get most of their W-2 withholdings back, which has led to tax refunds of $50,000, $100,000, and even $250,000 plus. So reps can be a very powerful tax strategy. The third tax strategy is this: the STR, or short-term rental loophole. This is the third strategy you can use to be able to use rental losses to offset your W-2 income. See, certain short-term rentals can be treated more like an operating business more than a traditional rental. Here's why this specific strategy is so huge. If your rental activity qualifies under the short-term rental rules, it's not treated as passive rental activity for Section 469 purposes. That means with this, you don't even need to meet the real estate professional criteria at all. If you materially participate, the activity can be treated as non-passive for the year. And that's what can create the opportunity for those losses to potentially offset your W-2 income. There are 2 common ways to qualify for the STR loophole. First way is that if your average guest stay is 7 days or less. And the second way is if your average guest stay is 30 days or less and you provide meaningful services during the guest stay. Now, let's break that down with a few examples. First, the 7-day rule. The IRS looks at your average rental period across all guest stays for the year. For example, let's just say you list your rental property on Airbnb or Vrbo and you get 10 bookings this year. And when you add up all of the nights, the place was rented for 60 days total. To find the average stay, the IRS looks at the total rental days divided by total bookings. So that's 60 days rented out divided by 10 separate bookings. And that's a 6-day average stay per booking. And that puts you under the 7-day rule. Second is the 30-day rule. Same idea. The IRS looks at the average stay across the year. But for this one, you also have to provide meaningful services during the guest stay. And by services, I mean hospitality type services during the stay. So think cleaning for the guests during the stay, linen changes, or support that feels more like a hotel. Here's a quick example of the 30-day rule. Let's say you have 6 bookings this year. When you add up all the nights, the place was rented for about 150 total days. To find the average day, you take the total rental days divided by the number of bookings. So that's 150 days divided by 6 bookings. That's a 25-day average stay, and that keeps you under the 30-day requirement. And once you qualify for the STR loophole, the conversation shifts and all of your rental losses could potentially now offset your W-2 income. Here's a strategy that some investors use, and I want to describe it accurately. See, short-term rental status is determined year by year. So in year 1, they run the property as a true short-term rental, meaning the average guest stay is 7 days or less. Then they pair that with a cost segregation study to accelerate depreciation in year 1. And if they materially participate that year, the year 1 losses can potentially offset their W-2 income. Here's a quick example. Let's say a couple has $300,000 of W-2 income and they buy an $800,000 rental property In year 1, they rent it on Airbnb or Vrbo as a short-term rental. Their average guest stay stays under 7 days. Let's say they do a cost segregation study and it generates a $150,000 loss in year 1. That $150,000 loss can potentially offset their W-2 income. Then in year 2, they can convert it to a long-term rental, and at that point, it usually goes back to passive by default. Wow, that's amazing. So we just talked about the main ways you can use rental real estate losses to offset your W-2 income. So to recap, the first way, the $25,000 mom and pop allowance. The second way, real estate professional status or REPS. The third way, the short-term rental loophole. So now you're probably wondering, how do I actually create these losses in the first place? Like I said earlier, real estate is unique because the property can be cash flowing, but the tax return still shows a loss. And that typically comes from depreciation. And a cost segregation study is exactly how people accelerate it. Here's the simplest way to understand what a cost segregation is. It puts your property into 2 buckets. Bucket 1. Bucket 1 is the long life bucket. Usually this is 27.5 years for residential rental property and 39 years for commercial property. This is referring to the building itself, the foundation, anything fixed to the foundation. Think the framing, the roof, the core structure of the building. That typically stays locked up in the long life asset bucket. Bucket 2. Bucket 2 is the shorter life bucket. Often that's 5 years, 7 years, or 15 years. This is where everything that wears out faster than the building is put. So think anything that can be moved or anything that's not fixed to the foundation. So think flooring, carpet, appliances, cabinets, and certain electrical and plumbing components, and many outdoor improvements like fencing, landscaping, and parking as well. This is usually done by working with a cost segregation specialist, and they often work with the engineers. They inspect the property, they take photos, they break the building into components, and they produce a report that supports the classification between the short life assets and the long life assets. And that is super important. Keep in mind, cost segregations by itself does not guarantee that you can use that loss against your W-2 income. It creates the loss. Whether you can use the loss now or carry it forward depends on the strategy lane you qualify. Remember, mom and pop, reps, or the short-term rental loophole. Remember, $1 saved today is better than $1 saved tomorrow. You typically want bigger tax deductions now and smaller tax deductions later. So the cost segregation study is the engine that creates these massive losses. But the strategies we've covered are the keys, and they decide whether you can spend that loss against your W-2 income now or whether it sits and it's carried forward for a future year. Hey, real quick, a lot of cost segregation studies can be done virtually or in person these days. If you want an introduction to my cost seg guy, and he typically comes with discounts, go ahead and shoot me an email. That's king@kifedicpa.com. Mention cost segregation study and I'll make sure you get those special discounts. And as promised, here are an additional 6 real estate related tax strategies that you can use today. Here's the quick list up front. 1 is 1031 exchanges. 2 is step up in basis. 3 is the home sale exclusion. Number 4 are opportunity zones. Number 5 is the property tax cap for itemized deductions. And number 6 is the grouping election. I'll quickly touch on them, but every single one of these can be its own video. So if you want a video on any one of these specific tax strategies, let me know in the comments below. Bonus number 1, the 1031 exchange. This is how investors sell one investment property and buy another without triggering a tax on any of the gain that they made by selling the property. This is a common way people keep upgrading and scaling their portfolio while deferring taxes. Number 2, step up in basis. This is a generational wealth play. See, when real estate is inherited, the tax basis typically resets, which can reduce taxable gains for the heirs. That's why some families hold on to property long-term instead of selling. So instead of selling that rental real estate property and giving it to your heirs, why don't you wait upon death, and when it transfers to your heirs, they pay no taxes on all the gain that you've had since you've purchased the real estate. Bonus 3, home sale exclusion. This is for your primary residence, not your rental property. If you meet the rules, you may exclude up to $250,000 of gain when you sell when you're single, or $500,000 of gain if you're married filing jointly. Typically, you have to live in your primary residence 2 out of the last 5 years to qualify. This is why people talk about strategies like living in a home, then selling and keeping the gain tax-free. Bonus strategy number 4, opportunity zones. This is a reinvestment strategy. If you have a gain, you might be able to defer taxes by reinvesting into a qualified opportunity fund under certain rules. This one's not for everybody, but when it fits, it can be super powerful. Bonus strategy number 5, the property tax cap for itemized deductions has increased. This is not a real estate strategy, but this impacts real estate owners. Property taxes fall under your state and local taxes, otherwise known as SALT, and your state and local taxes are part of your itemized deductions. So if you're not used to itemizing in the past, you might want to double check with your accountant and see if itemizing your deductions makes sense this year. Bonus strategy number 6, grouping election. This is for people who use real estate for the benefit of their operating company. I have a lot of clients that are dentists, and the dentists own a real estate property for the sole purpose of housing the real estate practice. In situations like that, though real estate is classified as passive, you can do a grouping election because it's a self-rental and you could potentially lose any losses generated in the rental real estate to offset your W-2 or business income in that case. So in summary, if you're watching this thinking, okay, I'd love to set up strategies like this for myself, that is called tax planning, my friend, and you've come to the right place. Tax planning is exactly what me and my team specializes in for families and business owners. Click the link in the description or the pinned comment to learn more about working with me and my team. And if you've learned something new today, do me a favor, like, subscribe, and share this with someone working on their own wealth journey. Until then, keep building and keep keeping more of what you earn. I'll see you in the next video.